Hi there, Taz Rover here, real estate professional, power connector, and community builder. Today I come to you with a great piece of information on credit scores. So I'm calling today's segment the anatomy of credit score and how to leverage it, because when we know the rules, we can win, right? All right, so why is credit important? What does it affect, and hacks to leverage it? So we know that, typically credit becomes important when we're looking for a mortgage to buy a home or maybe finance a car. Those are sort of the big ticket items. But there are other things that credit impacts on a more regular basis, and in fact, perhaps big decisions in our lives as well, right? Did you know that credit is used to give a quote to your car insurance or home insurance? Did you know that credit is run for employment? Particularly those who are young professionals or parents who have kids going into the job market. It's important to listen. And then something that's becoming more important lately, it's always been important, but particularly more important now, is business loans. Particularly grants and COVID relief packages happening federally or locally or county level are asking for a certain credit score as a qualifier. And, unfortunately, a credit score is a number, just one number, that helps institutions determine risk factor as they're lending money to consumers. And so, typically there may not be a lot of opportunity to actually look at the credit history of what makes up that score to make some exceptions, right? And so it's important to kind of have great credit scores all the time if we can help it. And so today I will go through the anatomy of what makes up a score, so you can have an idea of how those numbers are arrived at, right? And at the end of the day, the lower score we have, even if we qualify for certain products and loans, we end up paying more for them. So think about our hard-earned money that we work hard every day for. Why give up more of it if we don't have to? If it means putting in some work to tighten up our credit and qualifying for whether that means a lower interest rate, or any benefit that comes along with it, right? So pay attention. I'll be talking specific strategies you can implement, things to watch out for, things to do. So let's get right into it. So this right here is how the FICO score or the credit score is calculated, right? So you have a portfolio of credit lines, loans and different things like that. 35% of it is payment history. So if you pay your bill on time and are not late, this is 35% of the pie that makes up your score. 30% is amount owed, or this is often known as utilization, credit utilization. So what this means is if you have a credit card, say with the credit line of $1,000, you don't want to use more than $300. That's 30% of it, right? Ideally less, and ideally you pay it off, right? But if not, make sure it's not over the 30%. The 10% is credit mix. So what this means is it's better to have different types of credit lines. So for example, I'm not suggesting you go out and start new credit lines. I'm just letting you know how the algorithm works, right? So it's better to have a credit card, for example, a auto loan, and a student loan, for example. Those are different types of credit as opposed to 5 consumer credit cards, right? 10% is new credit. So if usually when we go to the store, hey, do you want to open up a new credit department store credit card so you can get the 10 or 15% off? And each time we have those inquiries, it can actually impact our credit in a negative way. And then length of history. So this is, the tough one to fix or hack per se, because you can't go back, right? So this goes to show how long have you been in a lending relationship with your lender. So if you have a credit card, if you've been using them for 10 years, for example, is better than a year. And by the way, those of you working on your credit, if you're thinking about cutting up your card and canceling them and not using them, cut it up. Do not cancel. Do not cancel, because it will hurt. This is the 15%, because now you've cut your longevity or length of credit history with them, right? So this is how it's made up. I think these two are pretty straightforward in terms of we have more control over them, you know, how much of it we use and if we pay it on time. These are a little bit harder to achieve, but it's important to know, right? You don't cancel, you can cut it up. All right, now that we know the anatomy, I want to let you know that there are different types of scores. So, you know, some of you who may be following your credit score on different platforms may see a number from the 3 major credit bureaus, Experience and the other ones. Those are good. FICO scores are generally better than consumer scores in terms of accuracy. Now there are different type of scores. So if, for example, you see 740 on your screen and you go to a mortgage lender and they see 729, don't be surprised, because they have slightly different risk factors when it comes to that specific loan versus, say, auto loan or versus, say, insurance, right? So they're in a general similar area, but they won't be exact. And that matters because up to, say, 740 or so, 740 or above, it's considered, you know, great credit. I think it goes all the way up to 850 or so. At least when it comes to mortgage, 20-point increments matter. What that means is if someone has a 719 versus 720, that actually matters because their risk factor goes by 20% increments, right? Now, if someone has, you know, 800 versus 850, it may not matter a whole lot because for someone to get to that 800, you know, they did all the things right. They paid on time and you know, their utilization was under, right? So the lesson here is definitely work towards a better credit score. If you have 740 or above, you, particularly for a mortgage, it may not make a whole lot of difference to continue to work on it before you make a decision like buying from a rate perspective. Now, in terms of how credit impacts our daily life, if you go from an excellent to poor credit, right, your home or auto loan insurance can actually double in premium, double. So this is what I mean by paying our hard-earned money unnecessarily. So if we can keep our credit, you know, in excellent shape, we're considered a less risky consumer, which means our premium is less. There's actually professionals called actuaries that work on these risk models, right? So they gather data from, you know, across the nation on age, accidents, area, and all of this, which is why you get those questions, right, when you're applying for insurance, and come up with what's considered you know, high risk, low risk. So the general consensus is that if you have high credit score, you are generally a less risky consumer. So when it comes to car insurance, for example, you're less risky to get into accidents, you're less likely to make a claim, for example, which is why your premium would be lower, right? Let's see, what else do I have here for you? So while, you know, all credit history is important, the last 24 months are more important and they are weighed heavier in the algorithm. And so if you had, you know, I don't know, collections or something in the past, just continue to work on it, continue to make payments on time because the last 24 months are important. And, you know, something that I recommend is to always get your credit report from freecreditreport.com. You're allowed to get once per year from each major credit bureau. It is my understanding that you might be able to get that more often than once a year now because of COVID and different things, you know, student loans and different things, having relief packages to ensure that creditors are not reporting inaccurately. So I definitely encourage you to look through that. When we purchased a home some time ago, I found an error in my own reporting that I wrote back and got corrected. And those things matter. They can actually impact your credit positively. We talked about new credits, right? It may kind of momentarily hurt your credit a little bit until you establish good payment history, and then it can help. Strategies. Here's a great strategy that a lot of people don't know about. So if you are looking to make a move, whether that's getting a job or whether that's getting insurance or whether that's purchasing a home, and your credit is shy of something, you know, that you need it to be in order to qualify for a better rate, I encourage you to look within your close family circle, mom, dad, aunt, uncle, sister, brother, to see if they can add you as an authorized user on one of their credit lines. Authorized user. What that means is, let's say on, uncle has excellent credits and excellent payment history. He can add you as an authorized user to that credit line. He does not have to give you the credit card. You do not need to have rights really to anything. What he's doing is he's technically leveraging his excellent credit history for yours. So now remember this mix we're talking about. So let's say you're a younger person and haven't had, credit history for a while. Maybe it'll help this 15% of longevity, because that's not something you can go back and fix. Maybe it'll add a healthy mix of payment history if you've missed a payment, right? So that's a really cool hack, and it's something I recommend in lieu of co-signing. I don't recommend co-signing for other people. Really, I think this is a more strategic way of helping them and helping them qualify on their own. So that's a really cool one. I've actually done this recently for a close family member that enabled them to get their first apartment, and it was really cool. I wasn't quite comfortable having to co-sign for them, but I was okay doing authorized signer, which made them qualified, and it was just really sweet to see. So that's pretty cool. So here are your action items. Your action items today are to request your credit report, comb through it really line by line, make sure you're comfortable with everything that's there, and dispute any incorrect items. And there's also a way to stop credit card offers. If you Google how to stop credit card offers, there's an online form that you can fill out to make sure that you don't get them anymore. Make sure you optimize the credit scoring formula here. And yeah, if you learned something new today, please comment below, share, tag. And yeah, this is mainly helpful for those looking to borrow, but for those looking to sell, trust me when I tell you there's a very, very tight inventory market. There's not enough inventory for particularly first-time home buyers. So if you're considering, get in touch. Let's talk. I hope this has been helpful to you. Have a great rest of the week. Till next time.